What if I told you that right now, as you're watching this, we are living through one of the most important economic moments of our generation, a moment that could reshape oil markets, stock markets, currencies, and yes, even cryptocurrencies like XRP. This is not just another headline. This is not just another geopolitical event. This is a historical global shift that is sending shockwaves across every major financial system on the planet. Welcome back to We Are Cosmic, the channel where we break down global finance, macroeconomics, and cryptocurrency in a way that is simple, clear, and powerful. If you're someone who wants to stay ahead of the market instead of reacting late, you're in the right place. Before we go deeper, I want you to type X in the comments if you believe XRP is built for long-term dominance. And make sure you hit that like button, because the algorithm favors those who engage early. Now let's talk about what is happening. The world is watching the Middle East. The United States has moved military assets into the region. Israel launched a strike. Reports have confirmed that Iran's supreme leader has been killed following that strike. This is not a small event. This is the kind of event that changes market psychology overnight. But the real focus is not just political leadership. The real focus is the Strait of Hormuz. The Strait of Hormuz is one of the most important energy corridors on Earth. Around 20% of the world's oil supply flows through that narrow passage every single day. Roughly 20 million barrels of oil pass through it daily. And right now, it is effectively disrupted. Tankers are turning back. Fleets are rerouting. Oil is sitting still in the water. Oil prices immediately jumped over 12% within hours. Why does this matter? Because oil is not just fuel. Oil affects inflation. It affects trade balances. It affects currencies. It affects stock markets. And when oil spikes, it creates stress in the global financial system. This is where things get very interesting. Japan, for example, imports most of its energy. When oil prices rise sharply, Japan's import costs increase dramatically. That worsens its trade deficit. When that happens, Japanese investors often pull money back home to cover costs. This strengthens the Japanese yen and forces what is called a reverse carry trade. Let me explain that simply. For years, investors borrowed cheap money in Japan because interest rates were low and invested it in higher yield assets around the world. That's called a carry trade. But when the yen strengthens quickly, those investors rush to close their positions. That means they sell stocks, sell crypto, sell risk assets, and move capital back to Japan. That creates volatility everywhere. So now we have geopolitical conflict, oil surging, global trade stress, and potential capital flows reversing. This is why markets are nervous. This is why volatility is high. But here's where XRP enters the picture. During times of global stress, the weaknesses of traditional financial systems become obvious. Slow settlements, expensive cross-border payments, liquidity bottlenecks, heavy reliance on intermediaries. These problems become magnified when the system is under pressure. XRP was built specifically to solve liquidity and cross-border settlement issues. When global financial rails are strained, solutions that offer instant settlement and low-cost transfers become more valuable, not less. And here's something important. Despite all this chaos, XRP has actually rebounded. That tells you something about underlying strength. Markets often price in fear quickly. When uncertainty becomes known, volatility can calm down. The unknown is often scarier than the known. Now that the strike has happened and confirmation is out, markets at least understand the situation better. That doesn't mean volatility is over. We still need to watch what happens when stock markets open. We still need to watch oil prices closely. But one layer of uncertainty has been removed. We are in uncharted territory. The Strait of Hormuz has never been fully closed in modern history. If oil pushes above $100 per barrel, inflation expectations will rise again globally. That could pressure central banks, that could pressure equities, and yes, it could create short-term downside risk in crypto. But here is the bigger picture. Moments like this expose systemic fragility. They show why faster, more efficient financial infrastructure is needed. Distributed ledger technology is not just a trend, it is an evolution of how value moves. And in that evolution, XRP is positioned as a bridge asset for global liquidity. We are not just watching a conflict. We are watching the stress test of the global financial system. And when systems are tested, the strongest solutions rise to the top. Because this is not just about one military strike. It's not just about short-term oil prices. It's about control over some of the most valuable natural resources on Earth. Let's look at the numbers. Iran holds approximately 208 billion barrels of proven crude oil reserves. That makes it one of the top 3 largest oil holders in the world. At current valuations, that oil alone represents trillions of dollars in value, but that's just the beginning. Iran also has the second largest natural gas reserves globally, estimated at over 3 trillion cubic meters. Natural gas is critical for electricity generation, heating, and industrial production. In today's world, energy equals power. Countries that control energy resources hold massive geopolitical leverage. On top of oil and gas, Iran reportedly holds hundreds of metric tons of gold, along with significant deposits of silver, copper, iron, and other strategic minerals. When you combine all of these natural assets, the estimated total resource value reaches into the tens of trillions of dollars. To put that into perspective, that figure rivals the GDP of some of the largest economies in the world. This is why global powers pay attention to this region. Energy is not just about profit, it's about influence, it's about currency stability, it's about trade agreements, it's about political leverage. If a major global power gains increased control or influence over such resource-rich territory, it reshapes the balance of economic power. Now think about what happens if oil supply remains disrupted. If 20% of global oil supply continues to face risk through the Strait of Hormuz, we could see oil prices surge well above $100 per barrel. Higher oil prices lead to higher transportation costs. Higher transportation costs push up food prices, manufacturing costs, and overall inflation. Inflation pressures central banks. If inflation rises again, central banks may delay interest rate cuts or even consider tightening policy. That puts pressure on stock markets. And when stocks struggle, crypto often experiences short-term volatility as well. This is where many investors panic. But as professional analysts, we must separate short-term reaction from long-term direction. Short-term? Yes, volatility risk exists. Long-term? Structural shifts are forming. Here's why. When global tensions rise and traditional systems are stressed, governments and financial institutions accelerate innovation. They look for more resilient systems. They look for faster settlement infrastructure. They look for liquidity solutions that are not dependent on slow correspondent banking networks. And this is exactly where Ripple and XRP have positioned themselves for over a decade. While many crypto projects focused on speculation, Ripple focused on institutions. They built relationships with banks. They developed cross-border settlement tools. They focused on solving liquidity bottlenecks. In times of peace, these solutions are useful. In times of global stress, they become critical. Let's also talk about capital flows. When uncertainty rises, money moves. Investors reallocate capital into what they believe are safer or more strategic assets. Some move into gold, some move into the US dollar, some move into bonds. Increasingly, some move into digital assets, especially those with utility. XRP is not just another token. It was designed as a bridge currency. It facilitates near-instant cross-border transfers with minimal cost. In a world where sanctions, trade disruptions, and currency volatility are rising, that capability becomes extremely valuable. Now let's consider something else. The Strait of Hormuz is only 21 miles wide at its narrowest point. That makes it easy to control or disrupt. The fact that it has never been fully closed in modern history shows how delicate the balance has always been. We are entering territory that markets have not experienced before in this scale. Whenever markets face something new, they overreact at first. Fear spreads faster than facts. But once information becomes clearer, rational analysis takes over. And right now, the market is transitioning from shock to analysis. XRP rebounding during this uncertainty is not random. It signals that some investors are looking beyond headlines. They are thinking about infrastructure. They are thinking about long-term adoption. They are thinking about regulatory clarity. Because at the end of the day, resources create power. But financial infrastructure controls how that power moves. Oil may fuel economies, but liquidity fuels global finance. And as we move into the next stage of this conflict, we must ask a critical question: how will global financial systems adapt? Now, let's slow this down and really understand something that most retail investors ignore: the reverse carry trade. Because this one mechanism alone can create massive volatility in global markets, including crypto and XRP. For years, Japan has had extremely low interest rates. Investors could borrow money in Japanese yen at almost zero cost. Then they would take that borrowed money and invest it in higher yield assets like US stocks, emerging markets, tech companies, and even cryptocurrencies. That strategy is called the carry trade. It worked well when the yen was weak and stable. But here's the problem. When oil prices spike sharply, Japan suffers. Japan imports most of its energy. Higher oil prices mean higher import bills. That worsens Japan's trade deficit. When that deficit expands, the Japanese yen can strengthen quickly as capital flows shift. When the yen strengthens rapidly, those who borrowed in yen suddenly face higher repayment costs. That forces them to close positions fast. They sell assets. They unwind trades. They reduce risk. This is called the reverse carry trade. And when it happens, it doesn't just affect one market, it affects everything at the same time. Stocks drop, high growth tech drops, risk assets drop, crypto drops. Not because crypto is broken, but because liquidity is being pulled out of the system. This is important to understand. Crypto markets are highly sensitive to liquidity. When global liquidity expands, crypto thrives. When liquidity tightens or moves suddenly, crypto feels it fast. So if oil continues to surge and Japan's costs rise further, we could see stronger yen pressure and more carry trade unwinding. That could create short-term downside volatility across financial markets, including XRP. Now let's be clear, this would not be about XRP fundamentals. It would be about macro liquidity conditions. This is why professional investors always watch currency markets. The US dollar index, the Japanese yen, bond yields, these are signals of capital movement. If markets open on Monday with heavy selling in equities due to fear around oil and geopolitical tension, crypto could temporarily follow that risk-off move. But here is where we need perspective. Short-term volatility is not the same as long-term direction. In fact, some of the strongest bull markets in history began during periods of geopolitical stress. Why? Because crises often accelerate policy responses. Governments stimulate, central banks inject liquidity, regulations get clarified faster, and that brings us back to XRP. XRP's long-term thesis is built around utility and regulatory clarity. It is designed for cross-border settlement, liquidity provisioning, and institutional use. These use cases do not disappear during volatility. If anything, they become more relevant. When traditional financial rails slow down or become expensive due to sanctions, currency volatility, or energy shocks, the need for faster and cheaper alternatives increases. This is why Ripple has spent years building institutional relationships instead of chasing hype cycles. They position themselves for real-world integration. Now let's talk price structure briefly. XRP has already shown resilience by rebounding during this uncertainty. That suggests buyers are stepping in. It suggests that not everyone is panic selling. However, we must stay realistic. If global markets experience a sharp liquidity shock from carry trade unwinding, XRP could retest lower support levels temporarily. That would not invalidate the long-term thesis. It would simply reflect broader risk-off conditions. Markets breathe in and out. They expand and contract. The key question is not whether volatility will exist. It always does. The real question is whether the underlying adoption trend is strengthening or weakening. And right now, the adoption trend for digital assets, especially utility-focused ones, continues to strengthen. Distributed ledger technology is not going backwards. Institutional interest is not disappearing. Global payment inefficiencies are not being solved by traditional systems overnight. So while the reverse carry trade could create turbulence, it does not change the structural shift happening in finance. Think of it like turbulence during a flight. The plane may shake temporarily, but the destination remains the same. Now that we understand the macro pressure, oil shocks, reverse carry trades, global liquidity stress, let's shift focus to something even more important for XRP's future, regulation. Because while geopolitical events create short-term volatility, regulatory clarity creates long-term value, and right now there is serious movement happening in the United States around crypto regulation. Brad Garlinghouse, the CEO of Ripple, recently made a strong statement saying, "The door to a deal is wide open." That is not a random comment, that is strategic language. It signals active discussions happening behind closed doors. For years, one of the biggest obstacles holding XRP back was regulatory uncertainty. Investors were unsure how U.S. regulators would classify digital assets. Was XRP a security, a commodity, something else entirely? That uncertainty slowed institutional adoption inside the United States. But now we are seeing momentum around legislation like the Clarity Act, which aims to clearly define digital asset categories and establish rules for the industry. When institutions have clear rules, they move faster. Banks do not operate in gray areas. They need compliance frameworks before deploying capital at scale, and this is where XRP has an advantage. Unlike many crypto projects that are still purely speculative or experimental, XRP was built with institutional integration in mind. Ripple has spent more than a decade working directly with banks, payment providers, and financial institutions around the world. That long-term relationship building matters. In times of global financial stress, institutions do not suddenly start experimenting with unknown systems. They look for solutions that are already tested, already integrated, and already compliant. If the Clarity Act or similar regulatory frameworks pass, it removes one of the biggest psychological barriers in the U.S. market. That opens the door for banks to adopt XRP-based solutions more confidently. Now think about this in the context of current global instability. Energy markets are unstable. Currency markets are volatile. Trade routes are under pressure. When uncertainty rises, governments and institutions want more efficient financial infrastructure, not less. Cross-border settlement today is slow and expensive. Traditional correspondent banking systems can take days to settle transactions. They require multiple intermediaries. They lock up liquidity. XRP's value proposition is speed and liquidity efficiency. Transactions settle in seconds. Capital does not get trapped for days. That efficiency becomes extremely powerful when markets are stressed. Brad Garlinghouse, highlighting that negotiations are active, suggests that policymakers understand this shift. The White House's involvement in broader crypto discussions also signals that digital assets are no longer fringe topics. They are part of mainstream economic strategy. If regulatory clarity arrives while global markets are searching for stability, adoption could accelerate faster than many expect. Now let's stay grounded. Regulation does not mean immediate price explosion. Markets move in phases. First comes clarity, then comes institutional testing, then comes gradual integration, and finally, large-scale deployment. But clarity is the first domino. Once uncertainty is removed, capital can flow more confidently. This is why many long-term XRP holders remain optimistic even during volatility. They are not just watching price candles. They are watching legal and policy developments. And here is something important. When regulation favors a project that has already built institutional partnerships, it creates a competitive moat. New projects cannot instantly replicate 10 years of relationship building. XRP's positioning is not based on hype cycles. It is based on infrastructure. In a world where global conflict highlights weaknesses in traditional systems, infrastructure solutions become more visible. So while short-term macro events may shake markets, regulatory progress could be the catalyst that defines the next major phase for XRP. In the short term, markets are emotional. They react fast. When oil spikes 12% in hours, when headlines talk about strikes and leadership changes, when the Strait of Hormuz faces disruption, fear spreads quickly. Traders reduce risk. Algorithms trigger sell-offs. Liquidity shifts. If global equities open weak and oil continues climbing, XRP could experience temporary downside pressure. That would not be surprising. Crypto often moves with broader risk sentiment during global uncertainty. But here's what smart investors understand. Volatility does not equal weakness. Sometimes volatility is simply the market recalibrating to new information. Remember, some of the uncertainty has already been removed. Markets feared whether a strike would happen. It happened. Now the event is known. Known risks are easier for markets to price than unknown risks. If oil stabilizes and there is no further escalation, markets could begin to normalize faster than people expect. In that scenario, XRP could benefit from relief momentum. But let's go deeper. The long-term value of XRP does not depend on a single geopolitical event. It depends on structural adoption. And structurally, several things are moving in XRP's favor. First, global financial systems are under stress. Energy disruptions highlight weaknesses in trade networks. Currency volatility exposes inefficiencies in cross-border settlement. This environment makes liquidity solutions more valuable. Second, regulatory momentum is building. If clearer rules arrive in the U.S., institutions gain confidence. Capital flows more freely. Banks move from testing to deploying. Third, distributed ledger technology continues to mature. Blockchain infrastructure is improving. Custody solutions are improving. Institutional participation is increasing. These are structural tailwinds. Now let's talk psychology. During uncertainty, weak hands exit first. Strong hands observe. Institutions rarely panic sell based on headlines alone. They analyze long-term positioning. If XRP sees short-term dips, that does not automatically mean the thesis is broken. It could mean liquidity is rotating temporarily due to macro pressure. Think about previous global crises. Markets dropped sharply at first. Then stimulus arrived. Then new technologies accelerated. Often crises speed up change. If oil stays elevated, inflation could return as a serious concern. That could force governments to rethink monetary policy. It could push countries to explore more efficient digital financial infrastructure. It could accelerate discussions around digital assets in global trade settlement, and XRP sits directly in that conversation. But we must also stay realistic. There is still downside risk if escalation increases. If the Strait of Hormuz remains severely disrupted, if oil surges well beyond $100 and stays there, if global equities enter panic mode, crypto would likely feel that shock too. This is why risk management matters. Being bullish long-term does not mean ignoring short-term risk. It means understanding it. Right now, we are in a transitional moment. The market is digesting geopolitical shock while also watching regulatory progress. The key question is not, will there be volatility? The key question is, where is the system heading? And the system is clearly moving toward digital infrastructure. The traditional financial system is slow, expensive, and fragmented. XRP was designed to fix exactly that. So while short-term candles may move up and down based on oil headlines and currency swings, the larger narrative remains intact. Now let's step back and connect everything. We started with a geopolitical shock. Military escalation, oil spiking, the Strait of Hormuz under pressure, markets reacting, fear spreading. Then we broke down the reverse carry trade, global liquidity shifts, and how capital movements can create short-term volatility across stocks and crypto. We discussed resource control, energy leverage, and why trillions of dollars in natural reserves make this region strategically critical. But here is the most important takeaway. Every global crisis exposes weaknesses in the current system. Energy shocks expose fragile supply chains. Currency volatility exposes trade imbalances. Liquidity crunches expose inefficiencies in financial infrastructure, and when weaknesses are exposed, innovation accelerates. This is the pattern throughout history. After financial crises, we get new banking regulations. After technology disruptions, we get new infrastructure. After global shocks, we get systemic upgrades. Right now, the global financial system is being stress tested in real time. Cross-border payments remain slow and expensive. International settlement often takes days. Liquidity gets trapped between intermediaries. When geopolitical tension rises, those inefficiencies become even more visible. This is where XRP's core value proposition becomes powerful. XRP is not trying to replace oil. It is not trying to replace gold. It is not trying to replace national currencies. It is trying to solve liquidity and settlement friction in global finance. And in a world where trade routes can be disrupted overnight, where currencies can swing rapidly, and where sanctions can change payment flows instantly, efficient settlement infrastructure becomes strategic. That is why Ripple spent over a decade building institutional relationships instead of chasing hype cycles. That is why regulatory clarity matters so much. That is why discussions around legislation are so important. When clarity arrives, adoption accelerates. Now let's talk mindset. It is easy to be optimistic when markets are calm and prices are rising. The real test of conviction happens during uncertainty. Right now, we are in a moment where short-term volatility is possible. Markets may react sharply when equities open. Oil could fluctuate wildly depending on headlines. Currency markets could remain unstable for a period, but none of those short-term reactions automatically erase long-term structural shifts. Distributed ledger technology is not disappearing. Institutional exploration of blockchain is not stopping. Global demand for faster, cheaper cross-border settlement is not shrinking. If anything, the need is growing. And here's something many overlook. Markets move ahead of reality. By the time mainstream adoption becomes obvious to everyone, the price often reflects it. The question is not whether there will be turbulence. There will be. The question is whether XRP is positioned on the right side of financial evolution. From a macro perspective, global systems are becoming more digital. From a regulatory perspective, clarity is progressing. From an institutional perspective, blockchain integration is expanding. That combination creates runway. Does that mean straight line price action? No. Does that mean zero downside risk? No. But it does mean the long-term thesis remains intact and arguably strengthened by the very instability we are witnessing, because instability forces change, and change creates opportunity. So as investors, we watch oil, we watch the yen, we watch equities, we watch legislation, but we do not lose sight of the bigger picture. The financial system is evolving, liquidity is being reimagined, and XRP is positioned at the center of that transformation. These are my professional thoughts and analysis based on the macro environment, regulatory momentum, and structural adoption trends. Now I want to hear from you. Do you believe this global shift strengthens XRP's long-term case, or do you see risks I haven't mentioned? Drop your thoughts in the comments below. If you found value in this breakdown, make sure you subscribe to We Are Cosmic, hit that like button, and stay informed, because in times like these, information is power. I appreciate your time and your support. I'll see you in the next one.